Good evening, everyone. I'm 𝗠𝘂𝗶𝗁𝗂𝗁, Senior Executive Corporate Communications Team at IFA Global and Brilliance, extending a warm welcome to each one of you who took out time from your busy schedules. I'm confident that this will be an enlightening event covering various asset classes and offering a multi-asset perspective and a special focus on Indian equities and their valuations. Let me begin by introducing our esteemed speakers. First, we have Mr. Kenneth Andrade, the founder and director of Old Bridge Capital Management Private Limited and Chief Investment Officer of Old Bridge Mutual Fund, where he manages the investment processes and leads investment in ideation. He has over 2 decades of track record managing equity funds. In his previous assignments, IDFC Asset Management Company Limited as a Chief Investment Officer. He has also worked as a fund manager with Kotak Mahindra Asset Management Company Limited. With over 30 years of experience in Indian capital markets, portfolio management, and investment research, his insights are something we look forward to. Joining him, we have Mr. 𝗘𝗾𝗂𝗁𝗂𝗁𝗂, who is the founder and CEO of IFA Global and Brilliance, which is the wealth arm of IFA Global. With over 2 decades of experience, Mr. Goenka has provided expert guidance to hundreds of companies and families across India, Asia, and UAE on their FX management and treasury. Over the last few years, he has actively advised some of them to manage their family's wealth using multi-asset and multi-geographic approach. His passion for creating value for clients, employees, and stakeholders has earned him numerous awards, including the 40 Under 40 Young Entrepreneur Award, numerous Forex and Treasury Awards in India and the Middle East over the last 20 years. Thank you.
Great. How are you doing today, Kenneth?
Very well. Good to meet you, and thanks for inviting me on this call.
Yeah, let's make the most of it, Kenneth. We have around 45 people right now. I think we had over 100 registrations. Typically, it's a 50% turnout. So hopefully we'll have around 50 people. And let's try to make the most of the next 1.5 hours. And my dear friends, we'll have the last 15-20 minutes for question and answers. And that's the time when Kenneth, who's very well known with his stock picking skills for the last 15-20 years, you can throw in and ask him questions on your favorite stocks. It's a private affair over here. And Kenneth, let's touch upon some of the global big moves, what is happening across asset classes, currencies, commodities, equities. Nobody knows what's going to happen, but we'll try to do our best with whatever we are prepared in the next. Great. Thank you. So just divided this into 2-3 parts. The first part, we're going to discuss about the valuations in India and globally and how the money has been moving. My dear friends, I'll just request everybody to keep yourself on mute and in video off. And let us just take this. And later on, when you ask questions, you can on your videos and mics. So the first half, we're going to talk about a little bit of the valuations. Then we're going to focus on the Indian valuation, large, mid, and small. There's a lot of discussions around that. And then we'll discuss about other asset classes. Now people have started talking about asset allocation, and multi-asset funds are getting popular again, Kenneth. And then last, one of our favorite topics of how the dollar is going to behave and what our outlook is, we'll spend some couple of minutes there. Right? So Kenneth, the first thing, there are two markets in the world, India and America. And those two markets are both very expensive. That's what people say. Of course, the earnings yield in India and America, it's crazy valuations. The average PE has been around 16, and every time the top companies in America, the profit pool is getting narrow and narrow, and the valuation indexing is going. And everybody is scared to leave America. And also in the extent of India, I think with earnings disappointing last year, future is looking better with the RBI printing. What do you feel that is the money shifting from America to the rest of the world? Like we saw Europe moving up, China is moving up, and some part is also slowly coming into India. I hope so. So, what do you feel? How this liquidity thing is moving around, and is this kind of valuation likely to stay?
Um, so, so let me put some, try and put some statistics. They might be not completely accurate because there's a lot of science that I dwell on. But US is close to about between 65 and 70% of global market capitalization.
Yeah.
They are close to about 24% of the world's GDP. Right. So quite clearly, a lot of market capitalization or valuations are predominantly sitting out of the US. One of the arguments going for the US is that amongst the top five or maybe 10 companies, they do not only supply to the US economy, but they are now global businesses itself. Okay. Meta's largest market after the US, or largest market by number of people, is India, and then it's the US, and then everything else. And you can say it with Nvidia and everybody else also. So those one of the arguments that actually they hold true. I wouldn't want to dispute that. But the pricing power is completely with the US economy and not so much with the rest of the world.
Yeah.
So it's a
Yeah.
market which, if you have to make money in the US, that market has to go from 70% of the world market capitalization to 80% of the world market capitalization. So
Yeah.
you necessarily need to look for companies out there that will do well and not markets out there to do well.
Got that. Got that.
The
So, yeah.
same holds true for probably a case in India also. You have India at about 4% of the world's GDP or close to that number, and you have market capitalization of about 5.5% of our GDP, and we haven't been at this place before. This is the first time that we've been there.
Yeah. Yeah.
So
So,
in these two
yeah.
markets, you would have to go stock picking rather than buy the markets itself.
Yeah.
Hmm?
Got that. Got that, Kenneth. So, Kenneth, you rightly said that the market cap is 5.5%, and that brings to my next question. That India have had a major shift in terms of the currency volatility was brought down to 2.5-3% walls for a pretty long time. Now the walls have shot up a little bit. Fiscal and current account have improved, and majorly all the numbers have been pretty good for India, apart from some earnings downgrades we saw recently. So now the world is looking at India in a different way, and in the last 2-3 years, we are not seeing the valuations below 20 Nifty valuations at all. Whenever we are seeing those kind of valuations, there is 4, 5, 6 lakh crores of mutual funds money line, which comes and buys the index. 25,000 crores of SIP is consistent, plus minus 500,000 crores. And large amount of FII money, which has not yet come, they are waiting on the sidelines if the valuations get very attractive. Now, my question is that if the interest rate trajectory in India is down, and maybe RBI has done their bit, and India is going for a re-rating with all these numbers which are so nice for India, and we might get some money in the, like the bond index inclusion, we're going to get in the equity, our allocation of equity for the emerging markets are going to increase, and also in Asian indices. So can we say that possibly 23, 24, 25, these could be the new earnings multiple for India? And India is never going to be cheap again.
So it's a So the reason why you're at 23, 24, 25 times earnings is also because as an economy and a corporate sector, you are generating all of your EBITDA and cash almost. So you have free cash flow economy. So if I have to take a cash flow yield, Okay, the markets are trading at a cash flow yield. The risk to this number is that if corporate India starts investing back into the ground, then your valuations will drop significantly sharp. Then you go back to a cyclical economy. Otherwise, you're pretty much okay. So 25 times earnings is your tops. Uh, okay, I don't think we'll cross that number for a while. I'm not too sure if we'll be able to do significantly better than where we are currently, but we not cross that. So you have the risk of getting into a capex cycle, which will absorb a lot of capital, and if it absorbs a lot of capital, okay, then valuations will trend downwards. So historically, every time corporate India has leveraged up, valuations have come down. Every time there's cash flow generation and debt is paid off, valuations are gone up. We are at the end of that cycle today. Okay, so there is no new norm. And we've always learned that historically, if you can buy a company and a business at a 5% cash flow yield in India, and the same is available at say a 10% cash flow yield in a place like Korea with the same amount of growth, why would you have a preference out here? So global capital is fungible, and if global capital is going to drive valuations, okay, then I don't think 25 is a norm at all. 25 is where we've never been before, and probably you will you seeing it now, enjoy it while while it's there. So give it some time. I don't think this is a runaway market. But again, I go back to the premise, the first part of our conversation, saying that in the US and in India, it's time to go stock picking, and it's not about buying the market itself. So we've already re-rated. Okay, the probability of going higher from here is, I mean, my guess is as good as yours, but I don't think we are going to go better than this.
Got that. Got that. So I got the point that it's a stock picking market, stock pickers market, and you just can't go by the index and expect a 10% return plus because the re-rating has already been done and it's become very tricky now. And 25 is the max that one can look at. I was hearing a couple of fund managers last week and they were saying that, that a huge re-rating is going to happen because interest rates in India and US, the difference is going to keep coming down, down, down. And so our valuation, which is the present value of future cash flows, keep going up and up. So of course, it's not as simple as it sounds, but let's wait and watch how the markets are going to look at. So Kenneth, now one more point that, of course, we all know that there are two markets in the world, and that shows from the graph here that has done fantastically well in the last many, many years. And most of the markets have had cycles have not been able to give a very nice dollar returns. And it's US and India have been a winner long term. Maybe next 4 5 years, maybe if it could be of China, who knows? But now, one thing is that the FII holding in India have been all-time low of the overall market cap. I think it's close to 16 17%. And now we are seeing some money coming in slightly. But broadly, any FII you talk, they are just saying that the valuations are too expensive and we're waiting on the sidelines. But 10 15% if the market falls, probably will be interested. Now, another theory is that if earnings starts improving in India and suddenly there is a gush of liquidity because US is slowing down and people are diversifying from US, they've invested in Europe and all. And if a part of that money also comes into India, and that money could be anywhere from 25 30 billion dollars to all the way 50 60 billion dollars, I don't know, then we're going to get a double gush of liquidity from domestic and international. And then even if the markets are overvalued, it can still go up. What's your thoughts on this, Kenneth?
I think demand will meet supply.
Hmm.
Okay, so if there is a demand for Indian stock, you already see enough of supply coming out, and it will come out from all over the place. So I'm not in a position to predict what will happen in terms of FII flows. But I don't think there is any illogical money out there. And all kinds of money that comes into any asset class is logical money, right? And if there's illogical money, it goes just as fast, right? So, so to expect $50 billion coming into this country at these valuations, um, since it's a private conversation, someone got to do something very stupid.
Got
Okay,
that.
I don't know what justification, if I'm that manager, I don't know what justification I would be putting out there, what justification I would be putting out there to my investment committee to buy a market at 25 times earnings. Okay, irrespective of what growth that might come out of that market, but at 25 times earnings, I don't think equity managers ever think like that. At least from the subset of company managers that I have noticed, I haven't seen something that ever happened. So I think that we will get our fair share of it all. Okay. Again, the risk to this entire marketplace, which you see coming up right now, is that Europe goes into a capex cycle, and those companies that are extremely cheap. Japan continues to do what they do, is basically a reformist at the corporate level, making sure that capital is returned back to the investor or to the shareholder through multiple formats. And China finally finding its mojo from a capital market perspective, because these three places are still giving you 10% yields and higher on equity ownership there. Okay, you might question on governance, etc., in that part of the market, but if you have to make money out of markets, I think these are the places, purely from a valuation spectrum, that look attractive. I'm not saying you should go there, but from a valuation spectrum that look attractive. India is going to be a stock picking market. US is continuing to be a stock picking market.
Got
Okay,
that. Got
so
that.
coming back to the FII flows, I think there is a very vast and large marketplace out there. If they have emerging market, they can go to the Chinese economy, they can go to Vietnam, they can go to Japan. India is probably not the only market that is there.
Makes sense. Makes sense. So three markets to watch is Japan, Europe, and China. Of course, China has some issues of its own, but as of now, people are liking China. So I think maybe a 10% deal can be made in these three markets. And
Yeah, it's been cheap for a while now. I'm not saying that it's
yeah,
a great place, but if you have to buy market purely on valuation, this is something which is reasonably attractive.
got that. Got that. So this was just one graph which talks about valuations. Of course, the bond equity earnings yield ratio is almost at 1.4, which is
Mhm.
a kind of average. So you feel that at this levels, is it like fairly valued or more than more than valued that one should be very, very careful with their asset allocation?
Um, you got to so my long term point of view on Indian equities is still positive.
Yeah,
So okay, let me put it this way: my long term economic growth on India is very positive. We will be one of the fastest growing countries in the world. In the near term, I'm bearish on returns. In the near term, I'm bearish on returns. So you might end up doing 7-10% EPS growth, 7 to 10% market growth. So your price earning multiple remains the same. Okay. So trajectory wise, we're doing all the right things, unless there's something that happens on the macros. But on the return side, I think we fast forwarded a lot of growth that is already there on the market cap side.
got that. Got that. Yeah, when you see the rolling returns in 5 years or 7 years, you start feeling that, these are like so juicy numbers. And is it likely to continue? I mean, you just apply common sense and put a rolling return of any flexi cap fund or a small cap fund or a mid cap fund. And suddenly people forget the time of 16, 17, 18, 19, what happened there. So I think uh, you're right. You're right. It's too juicy. And one has to be very, very careful in the current context. So I think we discussed on this. Broadly, the PE has been quoting below when 20 to 22 current earnings. And I think Any feeler you get by seeing this, Kenneth? Any block of years you feel that this is the kind of uh, movement the market is going to copy, like 5-8, something like that, in a dollar weakening trend, what has started? You get any feelers like that?
So we've had two phases of the market that happened, and I just remember one reasonably clearly, which we also put out in presentations. We hit an all-time high in 2008. Yeah, 2003 to 2008, I think the Sensex gave us about 37% return.
Yeah.
Okay. Then from the peak of the market to the next peak of the market gave you 1% return. From 2008 to 2000, I think 13 it was, which market gave you a 1% return.
Yeah.
Right? So I think we've already been through that cycle of 2003 to 2008.
Hmm. Yeah.
And we've been through the cycle of 2000, or we're already halfway through, I would say halfway through, but almost 6, 7 months through between 2008 to 2013. And that would stretch to 2020, 27, 28 onward.
Hmm. Okay. Got that. Got it. That's a very important point you mentioned, Kenneth, that from the 2008 top till 13, I think we got only 1% return. And I think let's reiterate the fact that from 2010 to 2020, I think Nifty return was around 6-7%, broadly.
Yes.
Yeah.
So I remember a phase before that. No, it was exactly this, yeah, phase around that time, 2013, right? Somewhere around 2013, or around that number. Uh, Equity, large cap returns, mid cap returns, small cap returns, and liquid fund returns, all the same.
Yeah. This was which period? 13 or
13, a decade. I mean, it was just a point-to-point reference. So if you take another point,
okay.
it'll be completely different. It's just a point-to-point reference.
Yeah,
Um,
yeah.
uh, Including liquid funds, everything was the same. So there's only one way to go. You just buy everything. You just sell your house and buy equity. And everyone is doing exactly the opposite.
Correct. 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 And 13 and 20 was a lost decade for real estate in Bombay, at least. Nobody
Perfect.
made. Yeah. Got that. Got that. So I think we have covered the valuations part. So there's a lot of discussions around that. Since you are a focused, uh, you like stock picking and you have in your asset allocation in your, I was studying, it was around 50, 30, 20, if I'm not wrong. 50
Hmm.
was large, 30 was mid, and 20 was small. And time and again, there has been a lot of talks that the earnings last 5 years for mid and small have been fantastic. It has been 25% plus CAGR, if I'm not wrong.
Hmm.
And the money is to be made in mid and small for the next 2, 3, 4 years if India's most beautiful part is going to be there. And a lot of these companies and sectors are in the mid and small, it's not in large. Now, going forward, Kenneth, what is your feeling? How should one allocate assets? I know there's no perfect answer when it comes to caps. It depends on risk appetite. But assuming the valuations that are today and the earnings that you foresee, what should be a good asset allocation among the caps?
Um, I think if you participate with where the markets are at this point in time, it should be pretty much where it is, right? So where is the market today? The market's at about 70% large caps, 20%, 22% mid caps, and about 8% small caps.
Hmm.
Okay. So if large caps do well over the cycle, they will protect the capital. 70% of your capital is anyway getting protected.
Hmm. Hmm.
Okay. And if you get your small caps and your mid cap portfolios right, okay, whether it's stock or whether it's mutual fund portfolios, right? I think that will continue to give you that growth kicker at points in time.
Yeah, got that. Got that.
So
So we should
if
be
you're
more
not
heavy
like,
now.
Yeah, but if you're a little more conservative, then I'll flip my small cap into my large cap portfolio, around 80% large cap and 20% mid cap.
Mm-hmm. So I
I
missed
can,
that. Can you repeat that?
if I'm a little more conservative, I flip
Yeah.
my small cap and run 80% large cap and 20% mid cap.
Okay. Got that. Got that. So I was just hearing one of the fund managers, and he was mentioning that the latest breadth in the market is declining. And that's the
Mhm.
reason you're seeing that some of your stocks in your portfolio is down 20, 25, 30%, whereas the index is doing very good. And some of the very good fund managers are unable to beat in the last rally because the index held on and the managers have not been able to perform because some very large stocks which has a large profit pool, they have done very well. A lot of these other companies have not done well. So the median is minus 11.6 for NSE 500, for Nifty 500, and the index has gone minus 4.6. So so the index looks good, whereas the stock portfolio is not looking good. Looking at that, Kenneth, I remember the time of 1819 and post that 1920 when all the great companies like Asian Paints, everything started going up, and the others were just falling apart. So do you feel that we are entering that kind of phase, which is possible?
Yeah, I think that was once in a lifetime. I have never seen something like that before. I've never seen something. I hope I don't see anything like that before again, because you make mistakes either during that period or after that period. You're bound to make it. So it's not an event that anyone was happy with at any point in time. But
Yeah,
I don't think it
yeah,
was a once in a lifetime event that happened, and for multiple reasons. It also got buoyed by the fact that the government cut taxes in exactly those companies that were doing well, which is basically the financials and the FMCGs. So it got accentuated because of that also.
got that, got
So
that.
there was an event that triggered an event which was already happening.
Mm-hmm.
When it was
Mm-hmm.
doing well, okay, fuel got added to the fire and it did extremely well. And that shook the foundations of everyone out there. So that, like I said, this is an event that happened. It was not something that I I know I will not see it for the rest of my working career. But I also cross my fingers and hope I'm right.
Great, great. No, I think some of the people who don't remember, I think there were a pool of stocks which were just going up and up and up in large caps, and the rest was just lagging behind, and everybody was looking like a fool, and only those people who had those stocks were looking like winners.
Yes.
And Kenneth, I mean, of course, I'm not a stock picker. I was not witnessing it very closely, but I'm sure a lot of fund managers had a very difficult time that time. I mean, it was crazy that time. So,
Even
Kenneth,
though
I
that's
want
not
to, yeah.
yeah, go
So,
ahead. Yeah, Abhishek.
yeah. So, Kenneth, I want you to little bit focus on your portfolio now. How are you selecting in the current context? Uh, what kind of sectors are you liking? And because the uh, earning yields across all these sectors are looking not very nice. The metals and banking, those are the kind of numbers which are on the basis of forward earnings, which are looking nice. So, what do you feel, and how are you planning in the next allocation in your portfolio?
So let me uh, try and encapsulate it a little. So there's market cap, okay, which exists today, and that's represented what people call as earnings, right? And market cap plus debt is enterprise value,
Hmm.
okay. So what we are putting of what our framework is let's put it this way is that we're putting cash flows ahead of market capital, cash flows ahead of earnings. Okay, and free cash flow ahead of earnings. And if you have a situation which you think is highly probable that over the next 5 years, cash flows get accumulated on a particular enterprise value. Okay. So you have the value of the business, and over the next 5 years, the cash flow accumulation represents 50% of the total value of the business. Okay. That gives me a comfort level and a margin of safety on my downside.
Got that.
All that accumulated cash is also my growth capital. Hmm? So again, we want high free cash. We want high free cash, and we want that high free cash to get accumulated on company balance sheets. They act as a margin of safety should something go wrong with the company or with the economy, with the company, or with the macros. And that cash flow can act as my growth capital. I can take advantage to grow the business. So that's how we position our portfolio. And when we position our portfolio that way, there's going to be a situation wherein we like growth, but we are not very confident on how to achieve it. We're leaving it to the manager. The 20 companies are there in our portfolio who are derivative of this output, and we hopefully get 50% of those companies do something very well with that. 50% of the companies will not do anything with that, but will remain at the same single digit to high single digit growth number. Okay, and that's how we put our portfolio together. Because as we stand today, India is about 4% of global GDP. Any developing to developed economy has gone by international companies creating international franchises. And if we are in a developing economy becoming developed, we have to go out and get global cash flows. Okay. So there are two spectrums. We are looking at companies which are rich, going out and getting market share, irrespective of whatever is happening with trade dynamics across the world, because we are an insignificant part of global trade. Okay, we got to go there and do that, and then accumulate more cash out here.
Got that.
Okay, so I hope I answered that question. We like the thematic of international franchises, and in terms of financial ratios, we like free cash generating companies. With that creates growth capex.
Got that. Free cash generating companies for growth capex and also your good margin of safety.
Yes.
That's what you're looking at. Great. So since it's a multi-asset theme, I thought the discussion has to be with gold and silver. So we just brought in a couple of slides there. Of course, I don't know whether we are late in the rally or we're going to see some dips, but then gold has compounded 10% plus CAGR in dollar terms, and with 2-3% of rupee depreciation, the numbers are as good as Nifty. So I think all the ladies of the houses who have invested in gold, they have looked very smart. And also the same case for silver, which has also been pretty nice. I think it's close to the 10% CAGR because of rupee depreciation in India. Otherwise, it's a 7.5% product long term. But one important point I wanted to focus here is that silver and gold, they also come with their own set of volatility. And I wanted to focus on that because I remember in 2013, I think, around that time, we saw a huge standard deviation in silver and gold both. And for a very long time, it didn't go anywhere. And the unfortunate was that people actually started investing lump sum once the cycle finished. So this time around, also, I think there's some more room maybe in silver. And possibly, I don't know how this global drama is going to unfold. But I think a lot of this rally has already happened, and I hope there is more juice left for both the commodities. Any thoughts, Kenneth? Any thoughts from your end?
I mean, my points of view will be very pedestrian on this asset class. Okay, so let me refrain from embarrassing myself on this forum.
So this is another ratio, Kenneth. A lot of people track. I often read in the news, and I was hearing Rhythm sometime back, and Rhythm was like, just buy equities because the ratio of Nifty to gold is like hit at the lower bottom. So either equity needs to fall down by 10-15%, or gold needs to go up by 10-15%, and we hit that 220 mark.
Yeah.
So with experience, Kenneth, of course, the data shows that. But what do you feel? What is the likely outcome here?
I mean, both can happen, none can happen. But if I go back into take equity investing as a subset or a parallel, there's always a reversal to mean. So find the mean and figure out what will get the ratio back to its mean. And I think
Yeah.
that's the way I would look at something like this. Like I said, um, my asset class of investing has been equity ever since I've known the asset class, and some liquidity. Those are the only two asset classes that I've had. Okay, and the Indian household has been one of the best SIP investors in the yellow metal. So they've done their bit. Now they're doing their bit.
Return equity, which generates real cash flows for real companies,
Yes.
for companies. I think
Mm.
that's also very important for our economy to go to a $10 trillion economy. So, anything specific? So there's a lot of noise around these factor funds like momentum, quality, and quant. Would you like to throw some light? Because what's happening is that people are jumping on the momentum bandwagon, and when the market falls, those strategies lose a lot of money. So what exactly is this? Can it just throw some light, and how should investors take this? And should it be a part of your asset allocation or a portfolio, or stick with index and active managers?
Uh, so if you have to enhance the beta of your portfolio, leverage it.
Hmm.
Okay, and the outcome would be almost the same.
Hmm. Hmm.
Okay, and if you and today you've got customized solutions or customized indices, which gives you a value index and a growth index, right? And I think that's what's creating all of these platforms that are there at the moment, with the indices that are there, or the platforms that are there, or these products that are there. They've been good in terms of asset allocation and points in time. But it's very important that these funds are also for very active investors.
Yeah.
Okay, so if you're a passive investor, and that's a definition that you just have to make sure that something like this suits your style,
Yeah.
because the risk rewards are reasonably high. So you're taking higher risk for a higher reward in some of these factor funds.
Yeah.
So it's never a no-no, because a lot of these products do well, uh, but they also hit cyclicality. So you'll have to be prepared for that cycle to come in. And when those cycles come in products like this, those cycles can be lasting reasonably longer than some of the active funds who have the choice of changing their portfolios.
Correct. Correct. So
So
the
knowing
title.
know your asset allocation, and these all will be a fraction of what your asset allocation will be.
Got that. Got that. And it's very important to get the cycle also right. I mean, if you don't get the cycle right, and instead of this, you are landed in this, then possibly, or you're not able to shift at the right time, then you might lose a lot of capital. Like we saw in the recent one, I think when the market fell down, I think a lot of these momentum funds lost a lot of capital.
Mm.
So I'll just little bit talk on the rupee because there are a lot of exporters and importers also here, Kenneth. So, of course, I'll take your view on this. What do you feel? I'll share some of my view. And so we feel that broadly, I think things are not as bad for rupee apart from the oil, which has been going up. I think broadly things are fine. Reserves are good. And of course, the US dollar is weakening, so that gives the benefit of the rupee strength. And it's likely to weaken more because of possible interest rates cuts in America. And broadly, the financials in India is fine. So nothing to worry. I mean, we are given a huge dividend to the RBI. RBI has given a huge dividend to the government, which is one of its kind to manage the fiscal problem because of the war budget and all that, which is great. And the overvaluation of the rupee has corrected. So the chances of depreciation of rupee too much is not likely. And I think as India, we are able to handle 75, 80, $90 of oil. It has handled in the past, in the last time. And I think even till $100 with RBI interventions, we can manage. And we should not see a runaway depreciation. Of course, what can break it is a huge risk aversion that we feel in US in case the rollover of debt doesn't happen or if they have to start cutting rates more than the expectation, that is two cuts this year and one cut next year. If that dot plot gets shifted and they have to start cutting rates because of a huge stagflation kind of an environment, uh, then obviously it's a risk aversion and then the emerging market currencies get sold. And that's something that is a risk which is there. But as of now, things are fine. So broadly, we expect relative depreciation of rupee by around 2% every year. That has been the broad trend. We would not like to change that. And whatever premiums one is getting by selling the US dollar, the extent of 1.5 to 2.2%, depending on what period you're selling, that should be taken into account by exporters. Importers did not panic. And as and when you get dips, you run Siegel strategies and out of the money call options to protect. And there's no point paying the entire premium for importers. With this, Kenneth, I would like to also touch upon one point, and I would like to take your view on this. Of course, time and again, we have all prayed that rupee becomes a strong currency, and it has not happened. And at the government of India level, also a lot of discussions have happened. We are a net importing country, so we are running a deficit. So demand is more than supply, so rupee depreciates by 1.5, 2%. Inflation was always a concern for India, but inflation is inching down. Interest rate differentials between India and America has also come down. What it used to be 3, 4, 5% earlier, now it's come down pretty low. So I know immediately we're still a net importer, but do you see a structural shift because of the re-rating that's happened because of bond index inclusion or equity inclusion in the major indices, and because of the stability that India is seeing overall in currency, fiscal, BOP, etc., etc. Do you see that 3 years, 4 years, 5 years down the line, we become an appreciating currency?
I don't know why we would want to become an appreciating currency at 4% of world GDP. I mean, that's a fundamental question that is there. I don't know any currency in the world which is going down that path. Because we've got 20% of the world population, right? So if we have to get to 20% of the world GDP, we've got to borrow our growth from the rest of the world. And for that, you can't have a strong currency. Okay. Um, um, but that's essentially what the way uh, I would see it. I mean, let's look at it this way. Japan's financial markets probably went nowhere. But if Toyota had to emerge as the world's largest car, it couldn't do it with a strong yen.
Right.
The same thing with Samsung emerging at 10% of the world's sorry, not 10%, the world's largest semiconductor company. They couldn't do it with a strong won. So why do you aspire? Why do we aspire to have a strong currency? It's fundamentally flawed. But while saying that, I think today we're probably more of a developed country than a developing country. If you like inflation numbers, if you take cost of capital, which is debt compared
Yeah.
to um, and if you take the top 10% of India's population or the top 15% of India's population, you will be close to the per capita income of some of the developed economies. So in some sense, we're already there. But if you have to necessarily go out and get the balance 40% of the population which is not employed right now, arbitrage can't only be labor cost, arbitrage also has to be currency. And you've got to help the cycle out. So maybe we go on to a gradual depreciation of the currency and not appreciation of the currency. You would also need inflation in India back again if you want growth. Because which entrepreneur is going to grow, put capital into the ground if there's no inflation? Okay. So those are some of the fundamental things that are out there, which is why I don't think we've finished our cycle of depreciating. It might come back to a lower trajectory, but we've not finished our cycle of of lower depreciation. So there are too many things out here that says that um, to have an appreciating currency, this is just not the time.
Got that. Got that. Got that. No, I agree to you. It's not a situation, and also with net current account deficit, and I don't think it's possible. I mean, people get scared all the time that rupee is going to go to 80, and when it went to 84 and all. There's the time I said just add 2%, 2.5% every year and keep depreciating. I mean, that mean reversion is likely to happen uh, because of the broad fundamentals which is still there. So Kenneth, I'll stop here and I'll open this for the question and answers. We'll just follow some protocol here. So anybody who wants to answer can unmute yourself and you can on your video and you can ask Kenneth questions. And please don't ask stock specific questions, ask general questions so that we are on the right side of the policymakers. So over to you. Please ask your questions. So I can see some questions have come. So Munawar asks that what's your view on firms deploying excess cash via treasury team into funds, stocks, and unlisted firms? Case in point, Mithun alloys, it reeks of capital misallocation. I don't know. Uh, I don't think so because see, I can only say one thing, Munawar, that with this growing bull markets, even I have seen a lot of money in companies which was parked in liquid funds and arbitrage funds has suddenly taken a lot of these monies going to AIFs and PMSs, which have no business to be. But then that's the way bull markets are. So let's take that as a pinch of salt, and it always happens that ways. Uh, this you can take. I think this is a general question. In the current market dynamics, what are the most prudent and viable investment avenues for deploying surplus treasury funds? Specifically, how you should organize and weigh options such as equities, debt investments, or alternative assets in terms of safety, returns, and liquidity.
So treasury management is not it's not a simple process because any treasury manager has also got a KRA to optimize returns. Right. So they're risk managers on the treasury because if my cost of capital is going to be, I mean, say 7% risk return, okay, and then it's going to be higher as far as equity returns. If my business is generating a 13% or 14% or 20% ROE, I've got to match those numbers. Right.
Yeah.
So you have to use treasury management in all asset classes out there to maximize returns. So I think that's the path to go. And investing in equities, investing in bonds is the same thing. If the bond money come, if bonds come back, the value of equity is significantly more. Right. That's how I basically think of it. So I don't think there's anything called misallocation of capital. It's basically risk management that is there, and which company is doing it well, which company is doing it terribly. We will only know once it's over and done with.
Yeah. In fact, I would like to share, Pavitra, that I've seen few investment policies which have allocation to all sorts of instruments and these are large companies, very large companies, and they have all instruments which they participate in. Having said that, if you want to uh, run it in a very conservative fashion, then probably arbitrage is the only way going forward in the current context. Because duration, you can't take much because duration cycle is kind of over, seems like. So I think arbitrage is the only options. But then if you're getting into equities, then obviously you need to have a proper investment policies in place with your drawdowns to be captured and written in a place so that the management and the board is very, very clear about what are you doing and why are you doing and what is the outcome and what is the risk. Yeah. Okay. We have this is Bharat from Reuters, Kenneth. Uh, Markets have navigated foreign outflows between October to March and has showcased resilience despite India-Pakistan and yet muted earnings. Now with Israel-Iran war triggering a rise of oil prices, inflationary risk for economy and earnings risk for markets intensify. How big of an event do you think the July 9 tariff deadline would be?
So I addressed some part of this answer sometime back, which is market is currently trading at a free cash flow yield of about 4%, which explains that 25 times earnings. So as long as you don't degrow that number, we should be okay. Right. So you will get volatility, but I don't think you will get a sell-off. So for what options do investors have in India apart from bonds and fixed deposits and liquid fund instruments is basically equities. And I think that's what everyone's been attracted to. What they're not, where you need to set the expectation that equity is going to give you a high single digit to a low double digit return for a couple of years before the market corrects and we go back to an earning cycle. So unless the earning cycle is significantly negative, I don't think the market is going to move out. So that explains what's happening between the foreigners and the Indian allocators of capital. Indian allocators of capital have very little options. They can't take their money abroad. They have to first buy it in India. So what you see happening with the luxury real estate market is happening with the equity market. It has become a very luxurious place to park money in. Right. And what's happening with the foreigners is that exactly the opposite. They find equity yields better suited to themselves. And that's why they're taking their money up and looking at arbitraging valuations between India and probably everything else. So that's why you get a mixed cycle of investor behavior, domestic investor behavior versus foreigners. Okay.
That's
Uh, so
It's a very relevant point, Kenneth. I think I would like to repeat that. There is a huge barrier of exit in
yes.
India when it comes to money. So $2 billion homes get sold in a week, like we saw in Gurgaon, or because you just can't transfer more than $250,000 in LRS in a year. And that also comes with huge scrutiny. And the taxation structure is also not very lucrative. So people end up buying anything and everything at any valuation in India, which is not in the case of a foreigner who gets to transfer its money wherever And in some cases, there is no capital gain in equity, the rest of the world. Correct me, Kenneth, if I'm wrong.
That's
And in India, there's capital gain also, tax at 12.5. So in that case, they can move their money freely, which we cannot. And we end up buying expensive stuff in India, and there is no other option. Only time will tell whether the returns are going to be made or not on those assets in inflated valuations, right? I'll take the last question, Kenneth, and then we can finish this up. So Bharat again asks that view on the sustainability of domestic flows. SIPs have remained strong, but overall equity mutual fund inflows have moderated, and mutual fund cash holdings are at elevated levels. Does that give room for mutual funds to come in and support markets in the near term? Do you see any signs of saturation in domestic flows?
So I would just put it back to a little bit of experience. Today, your 5-year return still looks stupendous. Your 3-year returns also look great. Your 2-year returns are also okay. Your 1-year returns is also moderate. The day these start deteriorating is that when your mutual fund flows go from strong to muted to negative. So let the 2-year or the 3-year cycle come through. And if you have a CAGR that looks like 4% or 5%, not that I'm saying it's going to happen, then the market will go negative. But as long as mutual fund returns are ahead of, say, a savings bank fixed deposit and alternative vehicles, I think they'll remain, mutual fund flows will be relatively strong. Now, you can project that to see how and when mutual fund flows will get negative. Okay. But if I look at 2 years of a single digit return, and if a lot of managers start underperforming their benchmarks, then let's put it this way, 2027 won't be a great year for IMFs.
Got that. Got that. So what Kenneth is saying is, of course, as soon as you start getting muted returns and people don't have patience, you're going to start seeing redemptions in SIPs, and fixed deposits will look better and arbitrage funds would look better. And then probably that 25,000 number is going to come down. In fact, Kenneth, I think in 2008, the numbers were stating that I think the numbers became down by 48% when that
Oh,
crash
yeah.
happened.
So 2000 and I think 12, 13 and 4, 2012, 13, they were negative flows.
Yeah, yeah, yeah. Because then there was a continuous 1% return average. So yeah, people were losing sleep on that. So great, Kenneth. I think I thoroughly enjoyed talking to you today. And it was a lovely conversation. And thank you so much for taking out time and sharing your insights. I think when you hear television, people have only one story to tell, and that's buy equities. I think Kenneth gave a very balanced approach that be ready for a muted return also going forward. You have to very much appreciate that market moves in cycles and it's not going to be a one-sided trajectory. We have seen times when we have not got equity returns and we have got bond returns. So it's not going to be different. So keep a balanced approach, keep an asset allocation, and select your fund managers wisely, and take your journey ahead of creating wealth for your families. Thank you so much, Kenneth. Thank you so much, everyone, for coming on this Thursday evening. Really appreciate your time.
Thank you, Abhishek. Great set of questions, and I thoroughly enjoyed myself putting together the answers for it. Thank you.
Thank you.
Thanks, everyone.
Thank
Thank
you.
you.
Bye.
Bye.
Bye.